Now, I'd like to welcome to the show Caroline Melear, a resident fellow in finance, insurance, and trade at the R Street Institute here in Washington, D.C. Welcome to Free the Economy, Caroline.
Thank you, Richard, so much for having me.
So now I'm excited to talk about favorite, one of my favorite financial tools, credit cards. I've got some great ones in my wallet right here. And so when we talk about financial regulation, we often see people tune out of discussions that are too technical or too inside baseball. Even after watching The Big Short, most people probably couldn't describe what a credit default swap is, and we don't really expect them to. But I think we usually do expect them to understand the consumer level stuff a little bit, checking accounts, balance transfers, late fees, and stuff having to do with credit cards, that sort of thing. But even though I think millions of Americans use credit cards every day, we still see a lot of kind of misconceptions about how they actually work. And I wonder, have you seen any of those things in your research? Things about banks and credit underwriting, those functions that people just get wrong.
Yeah, certainly. I mean, I think on the consumer level, there's a lot that is misunderstood or poorly understood. I think broadly, Americans are happy with their credit cards. They choose them based on a variety of factors, but two of the most popular reasons people choose specific cards are for their rewards programs and for their level of security. But I mean, I don't think that it's any secret to say that we do have Americans who have gotten themselves into trouble with credit cards and credit card debt. So obviously, there are some issues with consumers sort of understanding the more technical details of what their responsibility is in the credit card agreement.
Yeah, and I was thinking about how, when people often look very skeptically at credit card companies, the banks that issue them, and they say, "Oh, look, well, they just make all their money off of interest and late fees, and they're sort of like, weaponizing our own behavior against us, and that's way they make all their money." But they don't sort of understand the interchange fees, right? Like banks also make money just as a for providing that service to vendors.
Yeah, absolutely. And it's a huge benefit for vendors as well, which I think is also something that's sort of been lost in the discussion, especially as of late, because when a customer comes to your place of business, whether that be in person or online, and they present a credit card, it makes the transaction much easier. It allows the consumer to have more faith. If any issues were to arise, a credit card is the best product that you can use to make an actual purchase. You know that you have fraud prevention. You know that should you have any sort of merchant dispute, that you have your credit card company in your corner. But on the merchant side, there's a great benefit as well. People are more likely to complete a transaction. They're more likely to spend a little bit more, in fact. So I think that there's a lot of really mutual benefit. And of course, I mean, you spend on a credit card, you get a 30-day float. There's not many other products that allow that.
Yeah, that's sort of a free lending right there.
Right.
And I'm also it's interesting to me the sort of evolution of how credit cards and consumer credit has sort of changed in my own lifetime. I'm old enough to remember when not everyone had a credit card or even a debit card for that matter, and it was more likely for you to run into places that wouldn't take cards. And now you're more likely, there was sort of an upsurge in this during COVID for different reasons, but now you're more likely to run into places that don't take cash, right? Because both from the consumer side and from the sort of retailer side, there's a value to having uh, the sort of electronic track record of who spent what and under what conditions. If there's questions afterward, if there's accusations of fraud or someone wants return or anything like that, it's a lot more difficult to do that and keep track of transactions when things are just cash. And also, you don't have to worry about sending your closing night manager to the bank with $20,000 in cash, right? If everything has been electronic. So it's one of those, I think a lot of kind of economic evolutions in consumer behavior happens slowly enough that we don't see it on a day-to-day, year-to-year basis. But that change has provided a lot of value that's not necessarily obvious. The same reason why people like using Uber instead of just paying cash for cabs, because there's an electronic record of those transactions, and questions and concerns about them can be addressed in a way where you have that kind of evidence and security.
Yeah, absolutely. I mean, as a consumer, I'm sure we've all had a situation where we see a charge that we maybe don't recognize, or we see something that wasn't us at all. I mean, that's happened to me certainly. And you have the recourse when you have a credit card, and your recourse is much better. Certainly than handing over, like you said, we don't operate in cash much these days. So I think a more applicable example these days would be, maybe your electric bill, you put in your account and routing number. Well, that's not particularly secure, especially by comparison to a credit card. So yes, there's a great number of advantages that people really they definitely are missing them because, like you said, of that slow evolution. But I do think one area where consumers are very well aware of the benefits is the rewards programs. I mean, people are selecting cards if you travel quite a bit. There's airline cards, hotel cards, there's all sorts of branded partnerships. I have two little kids and I live in Florida. I have a Disney credit card. We go to Disney World, and we get, I get rewards points for Disney. So that is an area that's probably fairly niche. Might not be a lot of DC folks with the Disney branded credit card, but for us it works. I think that the amount of consumer choice is really, really valuable, and it's unique to the United States because we allow for more consumer choice. We don't have the severe regulatory barriers. However, we obviously know that this market no longer exists with debit cards because of the regulatory barriers that were put in place with the Durbin Amendment to the Dodd-Frank Act back in following the 2008 financial crisis. So this market used to exist for debit cards. It no longer does because interchange fees were forcibly reduced through that legislation.
And speaking of what's happened in different places in different times, the populist demands for low interest rates and things like debt forgiveness is as old as time. Anyone who knows a little biblical history probably knows that as well. We have records of kings and dictators and governors enacting policies like that going back thousands of years. And, you know, yet despite there being a long string of negative consequences when such policies were enacted, they keep popping up over and over. And you recently wrote something I thought that was fascinating that started with the title, "Both Ends of the Ideological Spectrum Get It Wrong with Credit Card Interest Rate Caps." Tell us about that how does that horseshoe theory work with both sort of left-wing people and right-wing people coming to the same bad conclusion?
Yeah, so that is in reference to a piece of legislation which would cap credit card interest rates at 10%. And that is sort of in the broader scheme of a topic I've been following a lot this year under the Trump administration, which is kind of these dueling ideologies between populism and deregulation. You see this among the administration. You have some of these individuals that are a little more on the deregulatory side. I think you can debate his level of involvement or influence, certainly, but Elon Musk, I would put him maybe more on the deregulatory side. I'd put Scott Bessent more in the deregulatory side, and then you have kind of the more populist leaning Vance. Certainly, I would put him over there. So. You have these sort of dueling ideologies that don't necessarily always makes sense. You can't really match free market with populist. So we see that coming through more and more in the Republican Party. And I think the interest rate cap legislation, which is in the House sponsored by Republican Anna Paulina Luna and Alexandria Ocasio-Cortez. So I think, we certainly know that those are two outspoken individuals of Congress and both very much on the ideological spectrum towards the end. And then in the Senate, it is sponsored by Bernie Sanders and Josh Hawley. So what you sort of see, and this is like a sort of a theory that horseshoe theory being, of course, the shape of a horseshoe at both ends, you kind of end up in the same place. And here we see that with price controls, which is obviously effectively what this is. We did hear, I think the motivation for the legislation is that, at least from the Republican side, is that Trump sort of briefly on the campaign trail said Americans need credit card relief. We will temporarily cap credit card interest rates at 10%. I don't think that that was really ever a policy proposal. I think it was sort of a Trumpism throwaway line. He hasn't said anything about it since, but they went ahead and filed this legislation. They took out the temporary part. There's no temporary cap, but nonetheless, it is sort of, for lack of a better term, a silly attempt at price controls. It's not, I mean, picking a single number to me it kind of makes me feel that it's not really a serious attempt. I mean, it's not tied to any sort of financial benchmark. They're just saying 10%. Um, but they're also trying to attach it to the Genius Act right now. Hawley filed an amendment to have it attached to that piece of legislation that will be debated next week. We're filming this on May 23rd, so next week might be this week at this point. But uh, it does appear that they may actually are trying to really push it through, which is something of a surprise to me. I thought it was maybe more of a messaging bill, but nonetheless, it's obviously. The downstream effects of such a piece of legislation are obviously very negative. You would reduce access to credit for millions of Americans. You'd really probably ultimately destroy the entire credit card system altogether. I mean, they simply can't operate at that margin. And even if the credit card system were to remain in place, like I said, you'd be reducing access to credit. You're also putting out that's really poor incentives. So, if you tell people your fees are less if you do the wrong thing, you're incentivizing people to do the wrong thing more, and you're not really going to help people out with their debt problems if they're incentivized to stay in debt longer.
Well, yeah, and this reminds me of a book from Ryan Bourne at the Cato Institute. He recently released a book called "The War on Prices: How Popular Misconceptions About Inflation, Price, and Value Create Bad Policy." And so he talks about how people are upset about the prices of all kinds of things, but one form of this hostility I think is interesting is that the price of credit, sort of money, money, the use of money itself, um, people seem to get sort of confused about that. For some people, they have kind of a trouble thinking of credit services as products in a normal economy and an interest rate as just a price, right? Just like any other price. So most people would understand if you said Congress is requiring the price of a loaf of bread is only 50 cents. Price caps on bread. And people would be like, well, that's probably a bad idea, right?
Sure.
Maybe it costs more than 50 cents to make a loaf of bread, right? Uh, but some of those same people, I think, would say like, yeah, let's stick it to the credit card companies, 10% rate cap. So why do we have such a trouble thinking, understanding of interest rates as a price, like a normal price?
Well, it's abstract, it's intangible, it's mathematical. It's not a direct price that people are really bearing every day. I mean, even if you have a mortgage, your interest is wrapped up into your mortgage. You don't necessarily, obviously, people pay attention to rates and what have you, but you aren't necessarily in your mind each month that you pay your mortgage, pulling out the interest and thinking about that as a separate, unique product. It's wrapped into what you are already paying. So I think the intangible nature of it is certainly part of it. But yeah, I mean, you're exactly right. There's not much of a difference between placing a price cap on a product as there is a service, which is what you're receiving. We could place price caps on all sorts of things, and we would see those products or services or industries deteriorate.
Yeah, and I think there's a lot of unseen here, in terms of what are you getting for that, potentially having to pay that interest. So, financial services are interesting because, especially in like consumer credit in this case, like you said, when you're using a credit card, you automatically get 30 days of free interest, right? Because you don't have to pay your bill till the end of the month. So I mean, that's a bonus, right? Like usually the
Right.
first three slices of bread are not free when you buy a loaf of bread.
Right.
So you're already coming out ahead there. Um, but there's all these other parts of the service that are sort of not obvious, like the secure network, all the transactions, all the record keeping, all the dispute resolution, all of that other stuff. and that other stuff is expensive to provide, right?
Of course. Yeah,
So, so
it is. And no one is more incentivized to provide it than the credit card companies and their issuing banks. They don't want to have data breaches or security breaches. Obviously, they are the ones who financially pay the price in not every situation, but in a lot of situations. So they are very much incentivized to have the best data security, best privacy that they can. And forcibly through the Credit Card Competition Act, for example, which would in effect reduce interchange fees forcibly. You are cutting off funding for a lot of those security programs. You are cutting off funding for a lot of the rewards programs, and it is again, it's abstract and it's hard for people to understand. And I think on the merchant side, I think it's important that we do understand the opposing views and how maybe they come to those thoughts. I mean, it's impossible to argue a policy if you don't understand both sides of it, I think. But I think a lot of merchants look at this and say, well, my fees will be lower, and that's what I want. Well, ultimately, the big box retailers, if some of these fees were forcibly reduced, would certainly stand to benefit. They did when debit card fees were forcibly reduced, but smaller merchants aren't going to, and especially if there are issues with card security. You don't want consumers to now not want to frequent your business because they had a card security problem at point of sale. And these days in the digital age, it really only takes a couple bad Google reviews to kind of wreck somebody. Um, so there's a lot that's, I think, kind of missing from the bigger picture. There's a lot that's just sort of saying, I want lower fees, and that's all I want. But it's not looking at the second order effects of what will actually happen, or again, analyzing the historic precedent that we have that's a very good precedent to look at and apply to this same situation here.
we've talked about what Congress might do, or maybe hopefully not do, in terms of, regulating, putting like caps on interest rates. But there's a whole, laundry list of federal agencies in the executive branch that have an impact on financial services as well. And, we don't have time to go to all of them, but I was wondering if you would be interested in doing a few highlights on some of these other finance agencies. What do you think they should be doing? Because again, obviously, every time if it's an executive agency that reports to the president, with a new administration, there's always a new opportunity for stuff to roll out or be rolled back. That you know, in this case, will could impact consumer credit. So I'm going to just go throw some acronyms at you, and you can tell me what you think the big news will be there. So one that's been very controversial, and there's been lots of fights about the Consumer Financial Protection Bureau, CFPB. The administration seems to want to shut that one down entirely.
Well, yeah, it's interesting. That was Elizabeth Warren's brainchild from the Dodd-Frank Act, and certainly under the Biden administration and the leadership of Rohit Chopra, the agency did quite a bit that was really kind of pushing the boundaries, to put it lightly, of legality of what the agency is allowed to do. And I don't want to get too into the weeds, but there's different standards by which they were able to push through some rules, some impacting credit through UDAP, unfair, deceptive, abusive acts and practices, qualifying different behaviors that they thought financial institutions or even fintechs were taking, that they classified as abusive, and therefore were able to put forth rules with very little community input or cost benefit analyses. So yeah, that agency under the Biden administration was certainly something of a problem, I would say. And it was no surprise to see it really dramatically reeled back thus far in the Trump administration. Most recently, we saw the McKernan had been nominated as director. They have since pulled his nomination, to my knowledge. And as of today, there is no one else that they have put up for that post. Maybe they won't put anyone else up at all. But they have rolled back a whole lot of rules from from the Biden era. A couple that I can highlight: the credit card late fee rule that was rolled back, so that would have capped credit card late fees. That is no longer in place, and I think we've already talked about some of the poor incentive structures that exist when you put some of these fee caps in place. I think that that applies that with that as well. So we were happy to see that drawn back. The overdraft fee rule is another one, which would have capped overdraft fees on bank accounts. That has been reeled back. And another one that I think is impactful, we didn't actually work on this directly at our street, but that is the medical debt rule, which would have barred medical debt from appearing on individuals' credit reports. And just something that I want to touch on with all of that is this the CFPB put forth all of these rules and many, many more with essentially no oversight from Congress. And they were very quickly drawn back in the new administration, which again, we're for that. We're happy they were drawn back. But the broader problem is the power of the agency and the power of regulatory agencies and the executive at large to be able to implement rules so easily. If my belief is that a rule, if it's that important, should be going through Congress. And I think that, again, you have all these sort of really unfair impacts for consumers who maybe they don't know that that credit card late fee rule has been withdrawn. Maybe they don't know that the medical debt rule has been withdrawn. And that can have really disastrous impacts on millions of Americans who are, I've used this term quite a bit, less so with consumers, more so with financial institutions and other groups. But we're suffering from sort of a regulatory whiplash from one
Mhm.
administration to the next that I think is
Right.
really unfair on everyone. And I think the ultimately the answer is that we have to rein in the executive and we have to rein in these regulatory agencies. That every single one of them need less power and less control.
Oh, here, here. So then we also have, so when it comes to banks, right? Credit cards come to us from the underwriting banks, the Federal Deposit Insurance Corporation, which most people are familiar with from the Great Depression, bank runs. This is bank insurance for people's savings accounts. Um, what what can or is happening at FDIC?
Yeah, I think the latest news on that. So, under the Biden administration, there were talks of raising the limits after the failures of Silicon Valley Bank, which obviously the Fed played a big role in those failures. So then empowering the federal agencies even more obviously is illogical. But under the Trump administration, there has been discussion of closing the FDIC but still providing deposit insurance. And I do think it's important to say that deposit insurance is not paid by taxpayers; it is paid by the banks. So, but having that function absorbed by Treasury. We'll see what happens with that and a lot of the other sort of deregulatory proposals. I do think, to be fair, that the FDIC is probably a fairly popular program among the American public, but nonetheless, closing closing some of the regulatory agencies and having them absorbed is probably not the worst thing.
Yeah, and then and this final one may have less to do with credit cards per se, but I just want to quickly mention Fannie Mae and Freddie Mac, the mortgage companies. That is, like you said, uh, paying your mortgage is sort of analogous in some people's households to paying their credit card bills. Uh, that's another case where you had a private market fund function, which technically deposit insurance could be in some cases, uh, sort of it was always kind of sponsored by the government, and then after the great financial crisis, kind of taken over entirely by the government. And there's been this talk. I was able to interview Mark Calabria several episodes ago, who used to be the head of the Federal Housing Finance Administration. That's one of the topic he's talked about a lot. Are we going to take these two mortgage entities and sort of spin them back off and let them be kind of mostly private companies again, or not? Where we've had.
Yes. So the latest with that is discussions of privatizing that has largely come from Besant. My understanding, though, actually, is that it was also a fairly big priority in the first Trump administration, and the onset of COVID sort of derailed any of those plans. But the idea is to privatize them, and we've heard Besant speak about this. I don't have an understanding of the technical details. I'm not sure anyone really does at this point, but that we would then create a sovereign wealth fund and we would raise money with the privatization. The government would still hold a significant portion of Fannie and Freddie, but that would be the first of its kind national level sovereign wealth fund. Um, the administration did put out or was planning to put out an executive order which would study the effects of the plan. But there has been no other movement beyond that. It is something Republicans have discussed over time as something that they would like to do. Obviously, less government in Fannie and Freddie and in mortgages more broadly would be a good thing. But it would be, I think that change would be certainly an uphill battle. It would take an act of Congress. The FDIC change would take an act of Congress as well, most likely. So we will have to see congressional Republicans be willing to come to the table on it. And that I think sort of remains to be seen. We have seen them be a little more bold with some actions than I sort of thought that they would be, most notably on some of the congressional review acts for some of the rules that came out of the CFPB. But we'll see where that's headed. It's certainly a bold plan, but it's a bold administration. I mean, they have a great number of deregulatory initiatives in financial services and across the spectrum that they hope to implement. And I think Trump understands the entire landscape so much better this time, obviously. But he also knows he's on a really limited time horizon, so he has to do as much as he possibly can as quickly as possible. And I mean that includes the upcoming midterm elections that he will have to face. And if majorities are lost, then that obviously impacts their ability to make meaningful change greatly. But he put forth the 10-to-1 deregulatory initiative, which states that for every one new regulation that is implemented by the administration, 10 will be withdrawn. That is not just in financial services, that's across the board. But nonetheless, they are intent on being very deregulatory. We have not actually seen from the administration itself a lot of the populist leanings that were so popular on the campaign trail. But again, I think that if we were to see maybe a broader economic downturn, that some of that could kind of tick back up. And I think you could even maybe see some of it in some of Bessent's comments as well. So sorry, that got a little bit off track there towards the end, but yes, that is a stated goal of the administration is to privatize Fannie and Freddie.
So yeah, potentially big moves at all of these financial regulatory entities. So just stepping back a minute and looking at the sort of idea of consumer lending, credit cards, and how people, Americans, feel about them. It's often said that politics is downstream of culture, and that the political policies that end up being approved have to sort of jive with people's kind of how they feel about the world. Whether they approve of something or not, or vote for someone or not, kind of has to do with more about their values and their hierarchy of values than it does with any underlying math, most of which we're really not digging into anyway. And one part of this, I think, that I'm sort of optimistic about is that this is something I've kind of, dived into a little bit just as a hobby and interest of my own. And we chatted about this for a second before we started recording, is this kind of online communities and social media content that is around credit cards. So among the people who consider credit cards like a hobby, right? They're always trying to get the best card. They're always trying to get the best sign up bonus. They're trying to get the best points, miles, rewards, and all that. And for them, that's fun. It's an interesting thing. They like talking about it. And there's tons of people on YouTube, on TikTok, on Instagram who some of them make a full-time living doing, credit card influencer stuff, and giving out these sort of value maxing tips and stuff like that. And so, I kind of I think if we had, like we said, we had some of these caps on interest rates, one of the things that would go away if we had, if you severely constrained the interest that companies could earn, is they'd get rid of rewards programs, period. And so that would be bad for any individual who had a card with rewards if the rewards went away, but it would also kill this entire ecosystem, right? It's almost a sub industry in itself of all of these people trying to provide valuable information to how do we get the best, household finance outcomes here. And I feel like that's one thing, that's one element of like these big regulatory initiatives that people don't really understand is that in any of these consumer areas, it's sort of like a coral reef, right? If there's something to grow onto, a community will grow there. And then if you decide, oh, we're going to shift where the water's flowing, then you kind of destroy that like little community, that spontaneous economic activity there. Um, and so, you know, I wonder what you think about again the sort of kind of like cultural attitudes here that there is this, this fight. On the one hand, there's this populist fight between the supposedly little guy here and then the big greedy credit card company over there, and that's kind of how we're thinking about it. But, you know, for me, there's this whole kind of subgenre of people for whom this is like, it's an interest, it's a hobby, but it's even kind of a career, even as an individual.
Well, regulation almost always has unintended consequences. And that is, I mean, several that we've already identified, I would say, in this conversation, but I think that that's one that probably hasn't really been specifically or particularly identified as the impacts that it would have on that segment of the population. I can think of a couple of kind of popular names that you're referring to that provide a lot of information to consumers, also small businesses. I mean, if you're running a small business and you have your business credit card, you can rack up a lot of points and you can use that even to pay down your bill. Yeah, I think that the impacts are even beyond the things that we could state because you wouldn't know fully until if and until it was implemented. But the negative downstream effects are some of them are obvious and others are more niche or less obvious, but they're always there with any sort of heavy-handed government regulation.
All right. Well, you've laid out a lot of maybes here, what Congress might do, what some of these big executive agencies might do. So we'll have a lot of opportunities to keep our eye open and maybe revisit this when if we see any of these major moves for good or ill. But in the meantime, thank you so much for being with us, Carolyn.
Thank you so much, Richard. Richard, I appreciate it.
And before we go, tell us where everyone can find your excellent work and analysis online.
Yes, so I am with the R Street Institute. You can find our work at rstreet.org. You can find me on X at Caroline Melear. Also posting on LinkedIn a little bit these days. You can find me there, Caroline Melear. And you can always feel free to reach out directly. My email address, cmelear at rstreet.org.
All right, excellent. Thanks so much.
Thank you.